Hey everyone, welcome to The Explainer. Today, we are unpacking a fascinating yet incredibly stressful paradox that honestly, almost every homebuyer eventually runs into. Have you ever noticed that strange contradiction where you sign the paperwork, successfully secure a massive bank loan, and yet you instantly feel completely broke? I mean, you've just been granted hundreds of thousands of dollars in purchasing power, but your day-to-day reality suddenly feels incredibly financially restricted. Okay, let's dive right into this. Why does getting approved for a mortgage so often lead to going broke? It is a massive emotional whiplash. One minute, you're popping champagne because the bank pre-approved you for your dream home, and the absolute next minute, you're sitting at your kitchen table, staring at your monthly budget in absolute panic, realizing you are officially house poor. To understand exactly how we fall into this trap, we really have to look at the math we're told to trust. Section 1. The 28-36 Rule Illusion. We constantly rely on bank mathematics to tell us what we can actually afford, but should we? We kind of just assume that if a multi-billion-dollar financial institution says we're good for the money, then we absolutely must be, right? Let's look at the absolute gold standard of this bank math, the 28-36 rule. As defined by Chase Bank, this is a lender guideline suggesting you spend a maximum of 28% of your gross income on housing and no more than 36% of your gross income on your overall total debt. On paper, this looks wonderfully neat. It's mathematical, it's authoritative, and honestly, it feels like a safe, protective boundary set up by financial experts to keep you out of trouble. Now, what's really interesting about this is how completely flexible these so-called strict limits actually are in practice. According to data from Zytro, which is a mortgage technology platform, these debt-to-income, or DTI limits, are highly elastic. While conventional loans might cap out at 50% with automated approvals, just look at the FHA loans. With strong compensating factors, FHA loans can actually allow nearly 57% of your gross income to go toward debt. Think about that. If you are spending almost 60% of your gross income on debt payments before you even buy a single bag of groceries, you are walking a very, very tight financial tightrope. Section 2. The gross versus net trap. This perfectly sets up the biggest pothole in the entire home buying journey, the harsh reality of the modern paycheck. Using gross income for your daily budgeting is a dangerous trap.
There is a massive cognitive dissonance happening here. The bank's math, that 28 or 30% rule, is calculated using your gross income. That's the imaginary number you make before reality actually hits. But in the modern world, before a single dollar ever hits your checking account, you have 401k contributions, health insurance premiums, HSA deductions, and of course, taxes. When you actually run the numbers, a quote-unquote safe 30% gross housing payment easily morphs into a crippling 50% chunk of your actual spendable take-home net pay.
To ground this abstract math, let's take a visceral reality check from the personal finance community on Reddit. User Papoose JR writes exactly what we're talking about. The 30% rule usually refers to gross, but honestly, you'll be a lot happier if you follow it as net. I'm at about 30% of my gross salary. It comes out to roughly 50% of my net, and cash flow has become a problem. This is the everyday struggle. It's not about being bad at budgeting. It's about using the totally wrong baseline number to build your budget in the very first place. Section 3. The lender risk secret. So why do banks use gross income? We really need to uncover the true motive here and understand why they let these limits stretch so incredibly high. Financial planner Michael Kitces pulls the curtain back beautifully on this. He reveals that mortgage borrowing limits are based on maximum risk, not prudent spending guidelines. Seriously, think about that for a second. Lenders are in the business of lending. They actually build their models assuming that a certain percentage of borrowers will fall behind or default. These DTI limits, they aren't a comfortable recommendation for your lifestyle. They are pushed to the absolute brink of human financial tolerance. So, the absolutely crucial point here is this. The bank's math calculates your threshold for misery, not your true affordability. When a lender says you are approved for a $500,000 loan, they are not saying, hey, we think you'll be very happy and comfortable paying this. They are saying, this is the absolute maximum amount of financial duress we believe you can endure without going into foreclosure. That is a radical but essential reframing of what DTI limits actually are. Section 4. Beware the phantom costs. Because the duress definitely doesn't stop with just the mortgage payment. These are the hidden expenses that don't show up neatly on your monthly principal and interest statement, but trust me, they will drain your bank account anyway. Based on data from HomeTap, your mortgage principal and interest is just one slice of a much larger pie.
The true cost of ownership is filled with these phantom costs. We're talking property taxes, homeowners insurance, escalating utility bills, and the golden rule of maintenance, which dictates you should expect to spend 1 to 3% of the home's purchase price every single year just keeping the place running.
And here's the kicker. These phantom costs are incredibly volatile. One of the biggest shocks for new buyers is the property tax reset. Often, your property taxes will spike significantly right after you purchase because the home is legally reassessed at your new, much higher purchase price. Add in sudden HOS special assessments for a new community roof or an emergency plumbing repair, and your carefully planned to-the-penny budget is just completely wiped out. Section 5. The psychological toll. When you combine maxed-out DTI limits, the gross versus net trap, and all those phantom costs, we really have to shift our focus to the human element. Ignoring these realities takes a massive mental health toll. Personal finance expert Ramit Sethi shares a perfect case study that illustrates this so well. Meet Sean, a college professor. He and his wife bought a $189,000 home. It seemed like a totally reasonable, good deal, right? But on their combined gross income of $52,000, that mortgage quickly consumed more than half of their actual take-home pay. It stripped away literally all of Sean's discretionary spending and forced him to take on a second job as a part-time radio DJ just to survive the phantom costs. The home effectively began running his life.
Or consider Jonathan and Shalom, a young couple who jumped from paying $1,800 a month in rent to a massive $4,500 a month mortgage. Listen to Jonathan's reality here.
When I put my head down my pillow at night, there seems like there's this huge liability of the house hanging over my head. That is the sheer anxiety and the sleepless nights that come with stretching yourself to the bank's absolute maximum limit.
Let's see how all of this builds into very clear warning signs that you are officially house poor. If you are trapped in a paycheck-to-paycheck cycle despite making a good salary, if you feel constant anxiety when the bills arrive, if you've had to cut out all discretionary spending, no dinners out, no small treats, and if you are relying on credit cards the second an emergency pops up, well, these are major red flags. Your home is trapping you in survival mode rather than actually building your wealth.
Section 6. Budgeting for real life. The good news? There is a way to prevent this entirely. It is time to ditch the bank's risky metrics, take back control, and rebuild your financial foundation based on your actual life. The way to do this is through a lifestyle-adjusted framework, often called a conscious spending plan. Basically, it flips the bank's math completely upside down. Step 1. You absolutely must start with your net income, your actual take-home pay. Step 2. Deduct your other fixed lifestyle costs, your car payments, groceries, utilities. Step 3. Deduct your required savings and investments. Step 4. Whatever is actually left over, that is your true, safe housing budget.
And this brilliantly illustrates the ultimate rule of thumb you should be aiming for: 60%. If you want to maintain your financial sanity, your total fixed costs, meaning your housing, your utilities, your groceries, your car payments, absolutely everything you have to pay every single month, should never, ever exceed 60% of your net take-home pay. This leaves 40% for investing, saving, and, actually enjoying the life you're working so hard for. So, as we wrap up this explainer, I want to leave you with a lingering, provocative thought to really mull over the next time you look at real estate listings. Ask yourself honestly, is your home funding your life, providing a safe base for you to grow and thrive? Or is your life funding your home, squeezing all the joy and flexibility out of your days just to keep a roof over your head? A home should support your dreams, guys, not hold them hostage. Thanks so much for joining me, and I'll catch you on the next explainer.